Hello, everyone. Welcome back to another episode of Let's Talk Housing. My name is Brendan Thomas. I am the co-host here alongside Stephen Thomas, chief economist and founder of Reports on Housing. Today, we'll discuss some recent economic news and statistics, baby boomers, 6% mortgage rates, the California exodus, and much more, of course. But Stephen, what is going on in the very tiny Thomas household?
Well, the entire family is here, and excluding my brother and sister from Wisconsin, your aunt and uncle, and all the cousins. Everybody has converged on in SoCal. It was my mom's funeral yesterday. We're recording this on Wednesday, the day before Thanksgiving. It was on Tuesday. We had the funeral, and now everybody's going to come over today and converge on our house, and we're going to have a whole bunch of Mexican food and just hanging out with family. That's what it's about. And that's really ultimately when you have a funeral of a parent like it was my mom, your grandma. It really does dial things in for me, and that is the importance of it's all about family. It's not about the stuff. I could hardly care less about the stuff. I want the relationships with all of these people. So that's really what it's about. It was a very emotional day, and so now we move on to everybody coming together. And then tomorrow is Thanksgiving Day. A lot of people are actually flying back on Thanksgiving because it was way cheaper to go back on Thanksgiving Day. But we will be, of course, having turkey and all the trimmings coming up. So can't wait for that. So how about you? What is going on? What's going on with you, Brendan Thomas?
I'd say about the same. I mean, we went to that beautiful funeral yesterday. It was very moving, but it was also very beautiful. It was just nice seeing so much family and the impact that one person can have on so many people, not even just in our family. I thought that was like very, very touching. Something that I really hope that I can have that impact on other people someday. It's definitely something that I looked up to her before, but now I could see really the impact that she had, and it's very, very moving. But outside of that, I mean, it's holidays, like I've been saying over and over. It's been coming closer and closer, and now it's here. And I'm sure you're gonna touch on the holiday market because it is. We are now heading like diving headfirst into that thing. So it's going to be very interesting. But Stephen, on that note, what is going on in the real estate world with supply, demand, and our very own expected market time?
Yeah, like it or not, the holidays are here. The days just click by, and here we are. Uh, my mom's funeral, which was absolute blessing seeing the different people there, but that was fantastic. But we're in the holidays now. I knew that the holidays were going to come. It's going to be hard for me come for us Christmas. On Christmas Eve is my mom's birthday, so that's just one little more snag in the whole holiday theme. But the holidays are here, no matter what. If you want things to slow down, they're not going to. And what that does is it's an annual seasonal pattern for the housing market, and this year has been no different. What happens is we get a drop in demand and a drop in inventory. Demand's already been slowly going down, so it's not like going down at a fever pitch any longer. We have had some adjustments based upon certain areas, but as far as inventory is concerned, we've peaked out pretty much across the board. We will see peaks, even for a market like I think it was Riverside County that still added a little bit. We know for a fact that from here it plunges till the end of the year. So we will have inventory and demand coming down at the same, both going down, and then that means that the market time typically doesn't do much. There's not a big change from now to the start of January, and there won't be unless we have a change in rates. Now, we did get rates that came down a little bit. I didn't see what they did yesterday, but I know that they came down because of the Treasury pick. Wall Street was cheering that on, and so it actually reflected in what happened to 10-year Treasuries and mortgage rates. So we had an easing in mortgage rates, and we're below 7%. Which is where we want to start off the year, is below 7%. So that's going to feed into a little bit more demand and a little bit more activity, more sales, things like that. So we just need to be below that threshold of 7%. But if you're looking for a lot of transactions, a lot of meat on the bones, it's not happening, because we're in the November. From here on, very few homes come on the market. And in December, of course, very few homes come on the market. It's just not the time. And it's the fewest homes come on the market then in December, second fewest November. And then that's why. And then there's a lot of sellers that have been languishing on the market, overpriced, and they're pulling their homes off the market as well right now. And it just increases from here on. So a lot will pull off their homes on the market from here to the end of November, and even more will come off in December. And that be the combination of the fewest number of homes coming in the market and homes being pulled off the market because of the lack of success, throwing in the towel, you will see inventories really come down quite a bit. And this happens every year. So there will be some naysayers that don't remember it, but even the naysayers that do it annually should know better by now, that there is that every year these trends occur, and we see the same thing year in, year out. Demand plunging, but so does the inventory.
You were talking about you didn't know how much interest rates went up yesterday. It was only by 0.02. So
Yep.
thankfully, we're still below 7%.
Let's keep it that way, darn
But
it.
so, Stephen, what has happened in the economy over the past couple of weeks? It seems like it's been a little bit of a dry spell in the economy.
Well, we're doing this today, and it's PCE, so that's something else that needs to be checked. Is what happened to PCE? I've been so distracted with my mom's funeral that I haven't watched much of anything. Yeah, I'm looking at the 10-year Treasuries right now are down 0.062, so that's a little bit more than a half, which is actually decent news. It's from a CNBC article. It's Fed's preferred inflation gauge rises to 2.3% annually. And that's meeting expectations. And the rise they're talking about is headlines. Headline inflation is not really what we care about. It's really core. So headline inflation is has more to do with fuel, and it's not really food. That's the issue. So it was already expected. That's why it meets expectations, even though the underlying underbelly of inflation is continuing to slowly trickle down. So with that even said, you see that the 10-year Treasury is fine. So we're going to get better interest rates. That's pretty important. And that is a pretty big data point for today. And that's going to be about it, because we're into the Thanksgiving week. Not a whole heck of a lot happens this week. It starts to get light today. It really, we have Thanksgiving holidays, and then Friday doesn't really count. It's not a lot of people working. You have to wait until Monday for things to start revving its engine. But next week is big. It's jobs week. And I've been waiting for this jobs week since the release of the first one in October. That one is going to be bigger than anything we've seen in a long time, because the jobs numbers for November had a big asterisk because we had the hurricanes in October, and we also had the strike, and it affected October's jobs. So this coming up week is going to be important, because we're going to find out what's going on with unemployment, payrolls, job openings, just a number of different charts and data points that will move the market. And it hits a crescendo on Friday. Friday is going to be absolutely huge, and everybody should pay attention to Friday the 6th. Friday the 6th is the day that will actually get that big jobs number, and that day could move markets the most in the last 2 months, because we've had the lack of a real data point in November. So it could be huge. Now, if this is less than expectations, we can really see interest rates come down towards 6.5%, which is where I want to start off 2025. It would be great for buyers looking to buy and homeowners looking to sell. It's just going to be a thawing of the market if we can get this rate below 6.5%. So maybe we'll get some cooperation from that jobs number. If it comes in at expectations, not a lot will happen. If it's too big of a jobs number like it happened in October, that's not what I anticipate at all. But if that does happen, all of a sudden we have high rates that are stuck right at that 7% threshold again, and that's not where we want to be.
Yeah, I mean, if we had rates, I mean, at like even 6.5 for about a month, we would definitely notice a difference in comparison to where it's at right now. Even with, I mean, the holidays coming around the corner, it would make that difference. We saw it before, and I'm sure that we'll see it again when it does happen. So it's just a matter of time now.
Yeah, it would be welcome.
Mhm. So, a quarter of Americans have almost no monthly savings as more and more people are living paycheck to paycheck, which is according to Bank of America. What are you noticing in the data that represents this, and what type of effect does this have on real estate?
Okay, that's interesting that they came up with the same data point that's similar to the number of credit card holders that are still paying off debt from last year's holiday season. Matches the people that have nothing in their bank account. So I'm starting to see the data points match, which means there are some struggling Americans out there. And if there are struggling Americans, means a little bit lighter of a holiday season, because if there are a number of maxed out credit cards. So that doesn't leave them a lot of room for the holidays. The holiday season still probably, by and large, is going to be just absolutely fine. But it gets to when you get into 2025 after the holidays are done, that's where we can see a pullback in spending. And this is a lot of renters. These are a lot of renters, even moderate income down. That's the pool of constituents or U.S. citizens that this is talking about. That demographic is the one that they're going to feel a little bit of a pullback in spending. So we can actually see that in retail sales and different other data points. So it'll be interesting to see how it all plays out going forward. But of course, we will be mindfully watching along the way. Now, I forgot to mention, but on the real estate side, there are so many people with good jobs and money in the bank that you're really not going to see this affect demand. And that's where when you hear these data points, you have to understand what the implications are. What we're looking at is what this means to GDP and consumption, and then what would happen with Wall Street and different things like that, and interest rates ultimately. So ultimately, this could affect interest rates, and interest rates would be coming down if the economy were to continue to ease and slow a bit. And if it continues to ease and cool down from its hot levels that it's at right now, you will see it in interest rates, which will fuel more demand. It's not that all of a sudden demand's going to shrink. That's not what this data point illustrates. What this data point illustrates is that there's some choppiness in the economy, which can lead to lower rates, which would fuel more of the housing market thaw that we were talking about. We need to get at 6.5% or below.
So, baby boomers, not Gen Z, are now the main generation holding down multiple jobs to make ends meet, per Fortune. Some 1.3 million people aged between 55 and 64 worked multiple jobs at once in 2023. Is there a light of hope at the end of the tunnel right now? What are you noticing, Stephen?
About to spit out my coffee. I could barely concentrate on what you were saying once you got to baby boomers age 55. That would make me a baby boomer, and I'm not a baby boomer. I'm about 5 years off from a baby boomer. So it just shows you how you age frame. Okay, they might have the 55 to 64 right, but at 55 where I'm at, I don't plan on retiring anytime soon. So that's not a big deal that I have a job. Most people my age have a job. Very few of them are desirous of, and I'm definitely not desirous of retiring at this point at 55 years old. So that they're talking about a subset that is Gen X and baby boomers. So they're crunching that together and talking about it as if it was one. So not a good job on Fortune's editors on catching this and even talking about it like this. You could just mention, rather than Gen Zs or talking about millennials, Gen X, or baby boomers. Pull all that out if you're going to just talk about 55 and 64-year-olds, because that's a totally different subset. And from 65 on up, that's what you should be focusing on, because you've got a big portion of that is just Gen X's, and Gen X's, of course, they're still going to be, they're still going to be working, and not. They say it's to make ends meet. There are a lot of people across the country that have always done that. That there will always be subsets of people that are trying to work just to make ends meet, and shoot, I still have kids in college and kids in high school, and we still have a lot of bills and things like that. So yeah, I'm going to continue to work, and a lot of us are, until probably around that 65 is where we'll probably cool down a little bit, because all the kids will be out of school and out of college and things. That's where things are. Life's a little bit different. So yeah, you're still living. You still have a lot more expenses when you have still have kids that you're supporting, but really wanes once you get to 65 and older, so you can start to enjoy things. So I just think articles like this try to steer things in a certain direction, and you have to understand the underlying economics of it.
As many of you listeners probably know, we follow a large amount of economists across multiple platforms. A well-known economist, Logan Motoshami, said something on X, which was a very interesting point to most people. He said, I am somewhat surprised by how demand has remained steady after 6 weeks of higher interest rates. I expected to see more weakness in the weekly data, but instead we've observed a flat trend in purchase apps. 6% rates really gets things moving. So I know we've said that a 5 handle could change the speed of the market, but could the threshold have changed to the sixes now that we've stayed around 6 and 7% just for so long?
Yeah, I like Logan a lot. He's a friend of mine. I'm actually speaking with him in January at an event, so that'll be pretty awesome. But yeah, I'm not seeing it. See, he's looking at a national numbers. He's looking at purchase demand, not purchase demand, but purchase application demand, and that doesn't translate specifically out to demand. But now, if you look at pending sales, there you have to go market by market and see really what's going on in the underlying data. So there has been a bit of stickiness in pending sales activity, a little bit more than even I anticipated. Some of it makes me scratch my head. Some of it is in markets like that were flat. That didn't really have that big giant jump up in pending sales when we were down to 6.1%. I wondered why not. It should be market. Every market should experience that, but there are some that were late to the party. And there were some that waited until the Fed made their half a point drop and then a quarter point drop, and they just don't understand it. What they hear out there is the Fed has dropped rates by 0.75% so far this year. And it didn't translate to mortgage rates, because mortgage rates went from 6.1 to 7.1. They went up a full percentage point while we were tracking all that. In the meantime, we had rates that were, the short-term rate was cut by 3/4, yet the long-term rate didn't match that at all, went up 1%. So if they were just looking at what the Fed was doing and jumping in, they might be, they don't know how surprised they are in the change in rates, but we are. So I think some of this is foolishness. I don't believe the data yet. I really do think that below 7%, yes, we'll see more than above 7%. We should have seen a lot more this year, but we were stuck above 7%. Because we had a lot more homes coming on the market this year compared to last year. Those extra homes, because we had 7% plus interest rates, actually accumulated. Had interest rates been below 7%, we would have eaten into more of the available homes, and they wouldn't have accumulated as much, and we would have had more pending sales activity and more closed sales activity. So it's just because there are more opportunities that are out there, and with rates below 7%, that will affect demand. We'll actually have more demand. Now, we get below 6.5%, and now you're just pushing on the gas pedal more. So the further and further we get below 7% and the closer we get to 6%, that we will definitely see a thawing out. Now, the real thawing out comes in the fives. And the reason that it still comes in the fives is because This is John Burns did a survey, and it's like 50% of all homeowners out there would consider making a move if rates were at between 5 and 5.5%. At 7% plus, it is only 9%. So 50% at 5 to 5.5, 9% at 7 to 7.5%. So you see that the further you get down, more homes will actually come on the market. So we'll get even more sellers. That's something that's very fundamental to me, because that will move the market a bit more, because now there's more movement. And yes, and all of these homeowners would become buyers as well. If they're sellers, they'll typically go buy something. So that just gets the churn going. It's not going to add, that doesn't leave the door wide open for a whole bunch of first-time home buyers to come in, because what people forget are more homes on the market. These homeowners actually become sellers once they have a pending sale. So there will be a lot more. The market will be a lot more fluid. We would go from frozen to thawed the more interest rates come down. So that's why we are rooting for rates in the fives. But the corollary to this is that the problem with getting down that low in the fives to thaw things out, what happens is we'll have such a giant increase in demand that it will outpace the number of homes on the market, and we will actually see values go up at probably an unhealthy clip is what we're anticipating. I would love for the market to prove me wrong, but based upon everything that we see and what we already saw when we were down at 6.1% for 1 week, what it did to activity and phone calls for everybody that is connected to real estate, that makes me a bit leery about where things are headed once rates really do come down.
So now that we're seeing mortgage rates having all this volatility, I mean, after the Fed cut, I mean, rates, like you said, jumped by a whole percentage point. Claims for 8% mortgage rates just somehow returned out of the blue. I don't know how. Um, is this even possible, Stephen? What are your thoughts on this claim?
Yeah, 8% mortgage rate's not going to happen. We had the big data point of the Treasury Secretary being for Trump's administration. Boy, that really moved rates this week, because he has a lid and a threshold. He's from Wall Street. He knows the numbers, and really can dive into financing the United States ridiculous debt and continuing ballooning debt, and he's going to help things along. And it's a really good ear to be within the administration. It's probably the number one pick so far as from an economic point of view. So you've got somebody in there that seems to know what they're doing, and that was why Wall Street said, yes, great pick, and rates fell, because what it meant is that he's going to have an eye on bond activity and rates going forward for companies and everything. So really, this boils down to it's going to be what the target is for it to come down even more from where it's at right now. What 8% rates would take are over 5% 10-year treasuries, and there is no way we're getting there. No way. There would be a lot of different positioning and different things that would be done on the Treasury side of things and on the Fed side of things, because that is way too restrictive. So, sorry, these when people say these things, it's like they're almost taking something that they're just thinking about and just spewing it on to these different chat channels and everything else and making headlines. It's pretty ridiculous. It's not going to happen.
So last episode, we dipped our toes into chatter that we heard about a year ago, which was the Airbnb crash. I mean, how fun. So today I wanted to ask you about the California exodus, as there was an article writing how the California exodus is fueling the boom in Arizona housing market. So what has happened over this amount of time? Have you noticed anything? Is there really an exodus, or is this just a little bit more chatter for a bunch of headlines?
Yeah, I mean, it was real. The California exodus was real during the pandemic. And that's when everybody felt like that once they went to, work at home, it opened up everybody's eyes as to where they ultimately wanted to live. And and if they were homeowners in California, they watched their equity just absolutely balloon. And as a result, they could sell their home and take their equity almost anywhere in the United States and sometimes just buy all cash or have a very small loan amount. It really made it easy for Californians that are homeowners to cash out and go anywhere they wanted to. Now, the revert, it's not true when you're coming from Arizona to here, or from Nevada to here, or from Knoxville, Tennessee to here, where when you look at median sales prices in the average home, it's not the same thing price wise as when you're coming here. They experienced a big change, but the change was much, much larger in California. So for them to come over here and be able to afford our houses, it's always been that. I've been doing this since 1991, and the values in 1991, a $300,000 house was equivalent to about a million. About a one today is about a $1.8 million house. And at $300,000, I just remember people coming in from other states and other areas, and they were driving around going, "How do these people afford these houses? What do they do for a living?" It's what they will always say for California. It's not what they said back in like the 50s and the 60s and even the 70s when homes were a lot cheaper and you could get a home in Newport Beach and it was actually not that expensive. It's a totally different thing now because now people have gone to California, realize what our weather's like, and not everybody can live here. So if demand's been really high, what's that done to prices? Prices have just absolutely skyrocketed as a result, and they're not going to be coming down anytime soon. So it prevents a lot of people from moving in this direction. But net, it's actually not that big of a difference. There's no exodus any longer. That exodus actually already took place, which is why the articles that we're seeing, that they're not coming from University of California where they used to come from, because they did all the data analysis and now they're not really doing it. And the reason they're not doing it is because net there aren't that many people that are leaving net. So it's not that big of a difference. It's definitely, the spigot is not as large as what everybody thinks. But the number, if you look at the sheer number of people that leave California, it is one of the biggest. It is the biggest across the United States. But there are also big numbers that come from Texas and Florida, because those two are big states. So it doesn't really feed to that story. So what you have to look at is the United States size is huge. California is gigantic and a big portion of the of the United States total. And what you're seeing is that it's just a big number, but percentage wise, it's not a big number. So you have to look at the details of it. The percentage of people that are I think Montana might be definitely in the positive, but if you look at the sheer number of people that are moving there, it's not as big as what everybody makes it out to be. It's not like Montana's all of a sudden going to become California. And I've been in Maricopa and Tucson and seen how they've been growing. And yes, they have been growing by leaps and bounds and building new stuff. And we can't build new stuff like they can here in California. We're just too landlocked. But in areas like Arizona, yeah, they can actually continue to build, and new homes fuel. People go, wow, I want a new house. So there are some people that move in that direction, and their job market has totally changed, and it's a totally different economy now that in Arizona. So it is going to lure some Californians that are cashing out. So I'd expect that to continue when you can sell an average house for $1.3 million and then go to another state like Arizona and you don't have that big of a mortgage. That's kind of some people don't want to have as big of a mortgage, and so they leave. But some people return. So I caution everybody that wants to do this. They're going to go to a market that, when it does appreciate, will not appreciate dollar wise, maybe percentage wise, not dollar wise, as much as it does in California. And once you leave and you watch percentages over time happen, it's very hard to return. So it's something that you should definitely consider if you're looking at the pros and cons of moving out of state.
So, John Burns' research found that buying a home in 2024 cost 42% more than renting one. What does this gap between the two tell us about the direction housing is heading in?
Yeah, that interest rates need to come down. This tells you why things are so unaffordable. At seven, it's really easy to write these kind of articles when we're stuck at 7% for as long as we have. Just keep in mind, it's going to move to from 27 months ago to 28 months ago. Once we get to December, the last time that we had interest rates below 6% into the fives. So that's such a long time ago, August of 2022. And by the time we get to 2025, it's all already going to sound like 3 years ago. So it's such a long time ago but once we do arrive there, it's going to, that gap is going to get better really fast the more that rates come down. And if rates come all the way down to 5% in, I don't know, 2026, I don't know when it's going to be, but you can imagine that gap just continues. I mean, it continues to be big, but it will continue to diminish and it won't be as big of a gap. And there will always be areas like California where it makes more sense to rent versus own. But the dream really is ownership because it is the pathway to making a lot of money. It's forced savings. You're going to be spending a lot of money on rent. Yes, you might have to spend a bit more in order to purchase, but in the long run, that rents continue to go up. But if you have a fixed rate mortgage that's fixed forever at a certain payment over time, that the rents continue to grow, but the payment stays the same. If these are 30-year mortgages, you can imagine payments the same. At around, it doesn't even matter if rates don't ever come down. At around year 15 out of 30, you're going to be paying so much in equity on a monthly basis that your equity position is going to be so much better. And rents will have risen quite a bit over 15 years that it's going to come up to par or even be more than what you're paying in mortgage on a monthly basis. And at the same time, you're going to be owning a big chunk of your home. So you have to look at that. And people go, yeah, I could have done better in stock market. Good. Well, then why haven't you been playing? Let me see your portfolio. Let me see what it looks like. This is a forced portfolio asset in being the home. So that's where I'd want to play along with diversifying your portfolio. But definitely, homeownership is a great path forward.
As you were speaking earlier, you were talking about being weary of the type of articles that you need to look at with the baby boomers and just like misleading headlines. So, something that I saw that I wanted to shed some light on was something from Meredith Whitney, who is deemed the Oracle of Wall Street after predicting the 2008 crisis. So, she said that prices are going to fall by 10 to 20% as the frozen housing market starts thawing. Where is this crash going to come from, Stephen? I'm just a little bit confused on that.
Yeah, me too. She's the oracle of Wall Street. She is not an oracle of real estate. And what she was talking about was the Great Recession. That was easy to forecast if you were looking at all the housing statistics, where the inventories across the United States ballooned to a point we had never seen since 1982, and that's the National Association of Realtors actually looks at inventory levels on a monthly basis, going all the way back to 1982 when we had far fewer number of citizens across the United States. That's continued to rise over time, continues to rise on an annual basis. You can imagine how much our population has changed since 1982. And that was the highest point was in 2006. That was predates the Great Recession. And there were 4 million homes on the market. And you could see it in the data as early as the fall of 2005. So definitely, there were breadcrumbs. It was that are left for this economic downturn. So you could actually make your way and see things happening and unfold before we even got there. By the time we got to 2008, shoot, we got to so many homes on the market. So 06, 07, 08 of 4 million. Where are we at today? We don't have that many homes on the market. I think we're at 1,350,000 across the United States. That's nothing. It is still a supply crisis. you need supply for the home values to come down that 10 to 20%. That's just a headline grabber, and she needs to stick to her lane, which is just Wall Street. And just because you were the oracle and you got it right once and you got really rich, great. That doesn't make you the Nostradamus for all economic data points. And this is our lane. This is what we see. So we don't see it in the numbers. We just don't. You'd have to have interest rates ride all the way up to around 8%, which is not going to happen. We've already talked about. You need supply. We will get more supply than we did this year. We got more supply than last year, more homes coming on the market. They accumulated because we had interest rates above 7%. That's what we've talked about. We'll have even more homes next year that come on the market than this year. Those will accumulate too if we're stuck above 7%, but that's not what we're forecasting. Our base case is between 6.5 and 7, and there are definite arguments. We just have to watch these data points coming out, these jobs numbers. We can get below 6.5%. If we're there for duration, wow, we can really see a big change. But even if we're stuck above 7%, rather than annual us be positive, we can go down, but it would be single digits down in numbers if it did what it did this year and we had 7% plus interest rates for the whole year. Yeah, I could actually definitely, we would make an argument for slightly down. And when we say slightly down, we're talking about down 1% that's not that great, because we've already talked about at the top of this podcast, and that was that we have inventory numbers doing what right now? It's the holidays, going down, not going up. They're going down. So because the inventory levels are already going down, it sets up the beginning of 2025 where they don't come on the market until we get towards the spring, and we have more demand that starts to occur by the time we get into January. So it will feel a lot hotter in the market at the end of January than it does right now, and it will continue to get hotter into February. And that's still not where a lot of homes come on the market, and that's where a lot of people in the real estate industry, agents, say this is the best time to come on the market. It's Super Bowl, and it's actually Valentine's Day. It's the middle of February. It's a really good time, and because there's a lot of demand and there's not a lot of homes placing for sale signs in their yard. So it's not going to get really where there's not going to be a lot of pressure on prices to come down during the spring market, because we won't have the inventory for it. It takes a while to build it. And where will that pressure come? The second half of 2025, if we're above 7%. And that's where you had pressure for prices actually to go up during the spring of 2025. And then that will reverse if we're stuck above 7%, like we're talking. And then you'll start to see values on a month-to-month basis go down slightly in many, many markets. And then net, you're just down maybe 1% for the year. So sorry, this just doesn't add up. It's just more foolishness of just talking and saying different things. It's not going to be down 10 to 20%. So Meredith is not a housing analyst for sure. She needs to stick to her own lane.
An infamous ex-user said that a house is not an investment. It produces nothing. It innovates nothing. It rises at the rate of inflation and interest rate manipulation. That's what they said.
Yeah.
What are your thoughts on this?
That's neat. And I know this person, it's like there's a lot of these people that exist. There's some people that profit off of this, like that Nick guy on YouTube. He's been wrong since 2020. Logan, who we talked about earlier, had a post. I actually loved the post, and it talked about all the crash calls that he had in 2020. And he's had it in 2021 and 2022, and everybody still listens to him. And the guy makes like $40,000 a month. It's just pretty funny that I guess you want to listen to some guy that's saying it's going to rain every day, yet it doesn't rain. Instead, it's sunny. And that's the analogy. It's still sunny outside, yeah, but it's going to rain next week, and then it doesn't rain next week, and then it doesn't rain the whole year. And they're just wrong all the time. So this, too, is just a ridiculous thing that somebody just makes up. They make up these little data points in their heads, and a house is definitely investment. I just talked about it, I think, a couple of answers back about how important it is to be into real estate and how that gap is going to change. And over time, it's going to force you to save. It is not an investment. It is a home. And Fortunately for everybody that is a homeowner, it becomes a great investment over time. That is your home. You're going to have to pay rent, or which is somebody else's mortgage, not your own, or you pay your own mortgage. And even if it's a little bit more, it's a pathway to owning your home. It's also a pathway for money saved, and money saved is a great investment over time. So implicitly, it is an investment while it is a home. It does not trade like an investment, which is unfortunately what a lot of these naysayers get wrong. That all of a sudden people don't panic and go, "Oh my gosh, there's it's going, the sky is falling. We need to do something right now." That's not what's going to happen. And they're all of a sudden going to not come on the market immediately because something negative is happening. We're not going to balloon any kind of inventory. We've already talked about that. And the only thing this does is keeps people in their homes when rates go higher. I don't see any pathway for any kind of crash or anything, but I can tell you it's a great investment over time. It does make sense for all the different reasons that we just talked about. And shoot, when I'm paying my own rent and my own mortgage, that's great on a monthly basis. For renters, you're still paying a mortgage. It's just not your own. So I would like to pay a mortgage that over time gets paid off, and over time I'll own it free and clear, so I don't have to pay a mortgage anymore, or rent, or anything. That's a pathway to, I could breathe again. And that's what people should be striving for now. By the time you get to about 30, hopefully that's when you're able to pull the trigger. And if you do 30 years out from 30, what are you? 60. That's pretty good. Shoot, you could wait till 35. 30 years is 65. Now you're owning your home free and clear. That's a good pathway. So there you go. So I think I've mapped it out for a lot of different people, and that's the way I would look at it. And that turns out to be a great investment, because now down the road, you don't have any kind of a rent on a monthly basis, or a mortgage, or anything. So I poo-poo ideas like this. They're just not looking at it the way it should be properly looked at, and it does not move like Wall Street, for heaven's sakes. It moves at a much different clip. I can tell you that right now. That's what they're having a hard time about. Those naysayers, it went up so much, and a lot of them are homeowners anyways, and happy where they're at, but they like to say negative things because they're rooting for negativity, because they're just negative Nellies. So that's what they're going to continue to do, is for as long as they shall live.
And if you don't want to believe us, you can believe the numbers, because the number of tappable, like the actual amount of tappable equity across the United States, is at $17 trillion. So if that's not a cushion, I don't know what is. But
And that's an all-time record. People talk about credit card debt being all-time record. How about that? 17
exactly.
trillion dollars.
But before we end this episode, I just want to say have a wonderful Thanksgiving and a happy holidays, because it's here. It's happening now. We are entrenched in it, fully and like immersed. But thank you everyone again for tuning into another episode of Let's Talk Housing. Like usual, if you want to learn about what's going on across the real estate industry, across Southern California, for the Bay Area, Phoenix, Vegas, anything like that, you can check out our YouTube or subscribe today at reportsonhousing.com. Please leave us a good review. We would greatly appreciate it. And if you have any questions at all, feel free to post it on our social media platforms, or you can email me personally at info@reportsonhousing.com, because we are always happy to answer these fun questions that I see everywhere and all these articles. You got to bring it up somehow and shed some light on it. So we will see you soon, and have a fantastic rest of your day. Thank you.
Thank you, and happy Thanksgiving.